Hello and welcome to MF Corner. I'm Somaiyaa Abdi and with me is my colleague Mangalam Malu. Well, for now, it's been a sort of a decent day for the market and it looks like it's picking up from there. So for now, about 350 points higher on the Sensex as we speak. The Nifty is up 1%. Banking stocks, of course, in all their glory today, but the mid-caps not so much.
Absolutely. Mid-caps not so much, but they're picking up as we speak. Case in point, something like an Exide at the high point of the day. We have, Escorts 2 moving higher, TVS Motor at the high point of the day, and alongside recent news that came by Sapna Bhrugu story of government looking to sell its stake in HZL. So HZL has moved higher, and because Vedanta holds about 29.5% stake in that one's moved higher as well. But we're talking about mutual funds and ETFs, Somaiyaa?
Yes, actually, recently we saw the launch of 4 index funds by Motilal Oswal AMC, which tracked the Nifty Bank, the Nifty 100, Nifty Mid Cap 150 and the Nifty Small Cap 250. But the issues have received only a tepid response. So I want to try and understand why that is. What is the reason that despite being advised as a part of the asset allocation plans and giving handsome returns, the humble index fund or even ETFs have not taken off? So joining me this afternoon, Aashish Somaiyaa, MD and CEO of Motilal Oswal AMC, and Manoj Nagpal, founder of Outlook Asia Capital. Gentlemen, thanks very much for joining in. Aashish, in the past you've successfully, you've had the Nasdaq 100 ETF, right? You've now launched 4 index funds simultaneously. This time, it's not seen the kind of response you would have expected, right? So what is the learning? I mean, is it that index funds, ETFs are ahead of their time in India?
Yeah, I think that one is that yes, they are a bit ahead of time. And in fact, when we started in 2010, that time we were clearly ahead of the time. I think now the awareness is in fact rising. And 2 important trends. One clearly is the regulatory trend. Because the regulator is definitely making mutual funds a bit more simplified, a bit more regularized and standardized. And the second regulatory trend is that the regulator is pushing from commission and distribution to advice and fee. And of course, investors are becoming more sophisticated. Digital is taking up in a big way. So if you are, digital and DIY kind of mode of investing demands simplicity. And in fact, one of the reasons why we did so many index funds, and they're not ETFs, they're open-ended index funds which take as little as $500, is so that it can be amenable to digital DIY kind of ecosystem. But on your point on the response, I think if you look at the rupees crores, then yes, it's not a large number. But I must tell you that all in totality, there were about 16 to 17,000 subscriptions which came in a span of a few days. And I would say more than 50% of that was digital DIY kind of response. So I'm happy about the number of people who have subscribed to it, and I'm not worried about the rupees crores right now.
Fair enough, Aashish, but if you look at the categories into which your index funds were launched, some of the categories like say the mid-cap ETF, what would be the market share, right? I can understand say the Nifty, even perhaps the Nifty 100. Why would you go beyond that? Or even Nifty Bank? I mean, why would a Nifty Bank be of interest to a new retail investor or a DIY investor?
So you know what, actually if you see the Indian market itself, the first clarification is that we have the first broad market fund, so it's Nifty 500, and those 500 stocks are 96% of the market cap. And I think that is of universal appeal, because I would say in one sentence that if you don't know what to buy, you buy the market, and the market pretty much is Nifty 500. But coming to your point on Nifty Bank, if you look at it, it's probably the best performing sector and the best performing index over the last 15 or 20 years. I think the compounded annual growth rate is like more than some 15-20% compounded right since maybe since the early 2000s, right? So, and it's even within the index, it is like a huge component. So I think banking has been something which a lot of people subscribe to, and it has been like a favorite. And the other parts, which is Nifty Mid Cap and Nifty Small Cap, you need to look at them as building blocks. So if you actually see our entire range, we are coming up with a couple more. So we'll eventually have Nifty 50, Next 50, Mid Cap 150, Small Cap 250, and you add it up all, it's Nifty 500. Right. So you're basically giving all the components, if I may take the liberty, you look at them as if they're Lego blocks, and you're building a composition.
Right, we'll come back to the point of how does one create alpha in the mid-cap end of things, and how difficult it would be for one to create the same sort of alpha in an index fund. But Manoj, one of the criticisms of the index fund is the fact that more and more people will start investing in index funds. There will be a lot of money chasing few stocks, and that is not something that is index fund driven. All of last year we saw just a handful of stocks keeping the frontline index afloat. Do you think this more money chasing a handful of stocks will further drive up valuations, and fundamentally that's a lopsided view?
Yeah, so currently what is happening in index funds, it's a very, new category for retail investors. It's still not developed for retail investors. So a lot of participation that we are seeing in index funds at this point of time or ETFs is through the EPFO, that is the employees provident fund that is there. So that now constitutes almost 80 to 85,000 crores of flows, and they are giving money on a consistent basis. So it's not really retail money that is driving it, and even the money that EPFO has seen is a small portion if you look at the entire market cap of India. And so it's when the flows become larger, that is happening globally. For example, globally almost 1/3 of the markets are ETFs and index funds, and then obviously this challenge arises that the same money is chasing the same stocks, and then depends on which is the index they are following. If as Ashish was saying, if it's a 500 index, then there's a lot of stocks, but if a lot of money is coming to a narrower index, then obviously this challenge can arise.
The issue of valuations, like we said, and he's spoken about the mid-cap index, Nifty 500, etc. I take your point that liquidity at the higher level is high, but at the lower level, they say mid-cap, small-cap, there would be that impact cost as well. Some money chasing a few stocks, and the stock price move will be much more pronounced, so that would make valuations more expensive.
Yeah, so when you're looking at the Indian markets of ETFs and index funds, I think the mutual fund industry has gone on a wrong track out there. They are giving options of almost 27 to 28 indices for a person to replicate. So now if a retail investor has to choose, he is actually choosing from 27 different kind of index funds that he can choose from. It's not Nifty, Sensex, mid cap, large cap. So it's the choice mechanism itself is very huge at this point of time, and it's just increasing. Motilal Oswal has just added 2 more to it, so now the entire category is 30 types of index funds you can choose from. The second point that you're looking at, are the flows commensurate? I don't think there is any flows that are happening in the except the Nifty and the Sensex ETFs at this point of time.
Okay, Ashish, we were speaking about this NASDAQ 100 fund that you had, right? So since its inception, it's given what, 24-25% in terms of returns. What is the way to generate alpha in these kind of funds? I mean, between managing that and now this, what have been the learnings that you see for the future, and what would you tell your peers in the industry who are also looking to launch index funds?
See, personally, I think some people may not agree with what I'm saying, but I think that there are a lot of people who are passionate about indexing and passive products, and I think they do a huge disservice to the concept by perpetually talking about alpha. Now, I don't think that the need for passive products starts and ends with the presence or absence of alpha. I think it has got to do a lot more with, like I mentioned, simplicity. I also mentioned that if you don't know what to buy, you buy the market. I think index funds or passive funds are the best way to make an asset allocation, because for example, if you populate the asset allocation with a large cap fund and then the large cap fund has 20% in mid caps, then what asset allocation are you really talking about? Whereas with passive funds, it's easier done. So I think that if people look at index funds from a perspective of simplicity and asset allocation and low cost, and so if we just move ahead of talking just alpha, because what happens is when you keep talking about that, you need to understand that there are very few people who invest in stock markets who understands what alpha is in the first place.
But they still want it. They may not know what it is, but they certainly know what they want.
So do they want it, but do they need it is also another thing to really think about, because I feel that most investors are just looking to beat fixed income with reasonable, tolerable volatility. That is first point. Second point is that the people who invest, let's say you start investing in equity, you get some basics, and then you understand that yes, there is a way of generating alpha. But I feel, my personal opinion is that a guy who lands up and knows absolutely nothing, he should buy Nifty 500. That's how I would put it.
All right, before we take a short break, we were reading the difference between ETFs as well as index funds. Manoj, which one would you prefer?
Well, ETFs globally are the new trend that's there for the last 5 to 6 years, or almost a decade, and most of the flows globally are happening in ETFs. And ETFs start doing well where there's good enough secondary market that's there and there is enough trading volumes. Now India, that is sadly lacking. In ETF there are 4 components: the fund house, the authorized participants, the market makers, and finally the retail investor. And all the 4 segments have to work together and develop market. Now in India the first 2 legs are there, but the second 2 legs are missing. So in Indian context, I think for the next 5 years or so, index funds are still a better way to go than ETFs, and maybe once the other 4 legs develop, then that's where ETFs will start doing well.
Okay, let's take a very quick break. We'll speak a little bit more about the ETF universe when we return. Do stay tuned to the MF Corner.
Welcome back. A handful of stocks, the likes of Arvind and MCX at the low point of the day. Remember, these are the stocks among the 12 stocks which go out of F&O trading from tomorrow. So which is why we're seeing some bit of exaggerated activity on both these stocks. Arvind, when I last checked, close to around 16 lakh shares still there in the September futures open interest. So we'll have to watch out for all these stocks and how these positions get squared towards the end of today's trading session. But we were in conversation with both Aashish Somaiyaa as well as Manoj Nagpal. We were talking about ETFs as well as index funds. Now, Manoj, the reason why people recommend ETFs is because of its low cost and hence better. But this low cost charge, is it offsetting the potential higher returns that one may get if one cherry pick the stocks?
Well, I'll tell you, in India people are fairly confused on why they are buying ETFs. Are you buying ETFs because of low cost, or are you buying because you want to, track the index? We have to understand that, what an index fund or an ETF, the basic premise or the promise that it's offering is that it will track an index effectively with a low tracking error. And if you want that, that's only when you go into an index fund or ETF. The costs do not matter. When I say the costs do not matter, it does not matter till the time the objective is getting met. Now, a lot of people have now started suggesting, because it's a low cost, and people saying that, in India there is a 5 bips, 7 bips, 10 bips kind of ETF structure. Now, in my view, always that's a wrong reason why you're going into it. If you are, for example, by definition, we're looking at an index. Index is an average of the market, and hence it most of the times will give an average return. So it will most of the time, the index returns will be in a second quartile. In Indian, the retail investors, somehow, people want to buy the best. They think that I want to buy the best fund. Whenever we speak to investors, they are saying, don't give me an average, give me the fund that is on the top. And that's how people start selecting funds based on the last 1 year performance. What they don't realize is that they buy 8-10 different such funds, and finally they are still getting an average return or lower than average return. So so this concept of being average is India. Every child is also taught that you have to be better than average, and that is the mindset that most of the people start trying to achieve, but finally end up being lower than average. So, coming to the main question, that if you're buying an ETF or an index fund, be sure why you're buying it. And the cost debate that I think is completely misplaced in the Indian context. We have, for example, I'll give you a specific example, the NPS, the National Pension System, works with almost 1 basis points. That's the lowest cost product globally, leave alone in India. So, in India, if you were to buy an active fund, with the lowest cost, then the NPS is the best way to go. Now, let's take the example of NPS has now 7 fund managers with the likes of HDFC, ICICI, Kotak, and they manage it actively. I'll give you statistics that, all the fund managers in NPS with a 1 basis point charge over the last 4 years have underperformed the index, number 1. Number 2 is that if you compare like to like, for example, if you look at the HDFC pension fund with the flagship HDFC mutual fund scheme, which is HDFC equity fund, which actually charges almost 2%, 1.75 to 2% of expenses, the HDFC pension fund is underperforming the HDFC equity fund. And I'm not pinpointing HDFC, all the fund managers within that, whether it's Kotak, Birla, ICICI, managing funds at 1 basis point, they're still underperforming the actively managed funds. And we have to keep in perspective that actively managed funds itself in the last 2 to 3 years have been underperforming the index. So low cost does not define, any kind of guarantee of returns, or it cannot be a model to choose. It ultimately you have to decide what your objective is. And as Ashish was rightly saying, that if you want to track the market, if you don't know anything about it, just want to track, that's the best way to go.
Okay, Aashish, I'll ask you this question is, we recently saw Blackrock exiting India, right? So they're one of the largest ETF managers in the world. If there was such a big potential for ETFs in India, don't you think they would have spotted it?
The potential is there. It's something which will be actualized over a period of time. So I don't think that it's a lack of potential. I think it's about competitiveness and the pricing and those kinds of things. Because like Manoj already pointed out and you were asking him, we are obsessed with cost. And I think...
and there's a very famous ad, right? Kitna deti hai?
Yeah, exactly. So cost is not the starting point. And also look at it this way that, somebody has created, there is an ETF which has EPFO. The EPFO has put nearly 95,000 crores. Now, I don't think everybody can or should get that pricing. It's absolutely irrelevant comparison. My last reading tells me that Vanguard on trillions of dollars make 13 basis points.
Yeah.
And in India, we are already down to 1 basis point and 2. So I think that one has to be realistic. But my sense is, I think the fact that we have done index funds which are more retail friendly, easier to do transactions, easier to get in and get out, and we are also helping people track the index at a reasonable cost. I think that should take off over time.
All right, he was talking about average returns, etc. And I remembered that Warren Buffett quote where he said that I'm not looking to jump over 7 feet high bars. I'm looking to jump over many 1 feet high bars. So talking about Warren Buffett itself, he said that on ETF, he said, and I quote, I think it's the thing that makes the most sense practically all of the time. Is it that developed markets have better propensity for ETFs as against emerging markets, and there are better opportunities in active funds?
So, one of the times when he answered at the Berkshire conference, I've attended quite a few times, and one of those when I was present, he was practically asked this. If you see the nuance, he said that everybody doesn't have a partner like Charlie Munger, and indirectly he said that everybody cannot be Warren Buffett. So if you don't know what to do, that's why I came up with if you don't know what to buy, you buy the market. That's where I came from. His answer was very nuanced, by the way. And he said that for the ordinary guy, it's better to stick to the average. I think that's where it comes from.
Okay, well, it's about time we wrap up, but Aashish, we just have a minute left. You're also launching your large and mid-cap fund, NFO, tomorrow. Do you want to tell us a little bit about, what you're seeing in the space? What's the outlook there?
I think, we are populating that's probably one of the last active funds that we will be doing for quite some time to come. The reason being that in India, if you see, why am I positive on that category is because in India, if you see, the biggest category of mutual funds is always a mix of large and mid-cap. Typically, multi-cap funds are pretty large. But I think what I've seen over the number of years, multi-cap funds have all become so large that the average mid-cap exposure is just about 20. So I think these large and mid-cap funds, which are somewhere around 50-50, are actually the multi-cap fund which you wanted but you never had. It's in that sense. And I think it has decent prospects. We always have huge prop commitment to our portfolio, so we'll back this one up also. And it's a good time to get started. That's what my sense is.
All right, Aashish, Manoj, thanks a lot for stopping by and helping all our viewers understand index funds, ETFs, and also talking about your new fund. Meanwhile, we're getting some news on Icici Lombard. The stock has spiked after that big large trade, 5.1% equity, I think, around 2.5 crore shares traded in multiple blocks, and as a result of which we have that stock which has spiked up. We'll take a short break, come back, and we get you a special explainer on what does yield to maturity or YTM means.